Greetings, YouTube. I'm back with a demo today. Gotten a request to actually go through how to build something on Composer.trade to explain a little about what these different pieces are, elements, right? And we'll go from the top. So when you create a what we call a new symphony, you would go into Create and then click New Symphony, which I've already done. I've given this a name. And I'll explain that as we go. Essentially, this is in the investing in the Nasdaq 100, which includes all of the Mag 7 and the AI stocks, etc. But it is a representative of an index. QQQ is the ETF. So there will be other ETFs that I put in here as well, and I'll explain them as we go. But for the start, what I like to do is to, if you click here, you'll get a choice of things that you can choose from. I'm going to choose group, and basically this is like a label, okay, just a naming label. So what I like to do is take the name of the symphony and just duplicate it here. The reason being is that later on you'll be able to copy everything you've done here and use it somewhere else. So it's just a good way to etiquette, a way to manage things. Okay, you'll see equal weight. These things show up pretty much every time you add something. So these don't do anything really until you have multiple items under it, in which case when we say equal weight, if you got two stocks, it's going to be 50-50 equal weight. If you have four stocks, it's going to be 25% or equal weight among four. So that's just to get started. But anyway, let's go through some of this now. Okay, so we've got what we want here, and we're just going to start with our first condition, we call it. Okay, so I'm going to click here, and it says if else conditional. Let's choose that. And this is called dual risk off because there's a couple of scenarios that will tell this to say, hey, the market's risky now. Why don't you switch to something a little safer while we're in this risky scenario? So there's a couple of different ones here. So I'm going to create one. And I won't explain a whole lot about why I'm choosing this, but I will say that the relative strength index is a very common one that's used here on this platform, and actually it's used all over technical analysis. So if you haven't seen it, you will for sure. Okay, so I'm going to say 10-day relative strength index of, and the symbol I'm going to use to measure this is KMLM, which is basically a commodity tracking index. When the stock market's doing really well, this tends to underperform. So when this is outperforming, we'll say the tech sector, and I'll just say is greater than the tech center, and we're going to say same thing, relative strength index 10 days, right? We're apples to apples, and then we'll say XLK. And some of you may know this is the XLK is the technology sector. Okay, very very similar to the QQQ. All right. So we have that. So I'm saying if this is greater than the XLK, I want to go into equal weight of three different assets. Let's do that. First is GLD, which is gold. And then you can just continue to type. If you got more than one, you can add it here. BTAL, which is, it's called a anti-beta fund, which is when the market's risky and it's maybe starts to come down as a whole, this will tend to outperform. Either it won't go down as much or it'll actually gain if the market is selling off. Okay, and then the third one we're going to do is short, PSQ. This is short the QQQ, so if the QQQ is down by 1%, this would be up by 1%. It's a minus 1x, okay? There we go. So now let's take a look what we got. So here we got this. If this happens, enter into 3 positions equally. All right, these are 3 equal positions. Got it? Now, if this is not true, we have to tell it what to do. So I'm going to save a little time. Well, actually, let's go ahead and do it. So you could actually recreate this if you're in the platform, which, by the way, you can create a free account just to do this, to see how you like it, play with it. And there is a code below if you want to join. You can use that code. It's 25% off. Okay, so we're going to do another conditional here. So if this is not true, right, we'll go else, and then we're going to choose another thing to look for. We're going to do 30-day relative strength, 30. And what we're looking for here is TTT. This is a short treasury bond index or ETF, and we're going to say if this is greater than the 30-day relative strength of SHYG. This is a corporate bond ETF. These are bonds. Okay. If the relative strength of what is a short bond, government bond ETF, is greater than a corporate bond index, that tells you that the bond market's not doing that well, which in turn will affect the stock market. Generally, stocks will underperform also when bonds are underperforming. Okay, so in this case, we're going to do equal weight for GLD, which is gold, and we're also going to add. Now notice if I come back here, there's a little plus sign. If you hover, I can add another one here, and that's what I'm going to do. Asset. And we'll add that BTAL, which we had done above. Okay, so now we have this. We have one condition. If that's not true, we're going to go to this condition. And if that's not true, that's when we're going to go into QQQ, which is the NASDAQ 100. All right, so actually most of the time we would spend here because these things only happen occasionally, right? But we're putting that first because we want to filter out those times when the market's at risk first. It's logical. You can do the flow. If this isn't true, we go to this one. If this isn't true, then we go to this one. All right. Now, I'm going to take this out and add one more conditional I forgot to put in there. We're going to do this, which is just to make sure that we're not in a bear market. And when the price of QQQ is less than its 200-day moving average of price right here, that's averaged the last 200 days of QQQ, then, I'm sorry, did I say less than? I meant greater than. Greater than. All right, so in a normal market, this is like probably 80 to 90% of the time, you're above the 200-day moving average. So this is a normal market. So we're going to go ahead and put the QQQ in there. All right. And if not, then we're going to go into 2 assets. Again, this time it'll be gold. So you can see here that gold tends to be a safety asset. Also, the US dollar is, and we have a ETF for that too. This is a US dollar index trust. So here we got an equal weight of gold and the dollar. Okay, so that is it. All right, so let's make sure we got everything. Yeah, that looks good. So let's go through this top to bottom. One other thing I want to do is I want to change it from a daily setting to a threshold setting. And what this means is if any of these things on a daily basis, you can overtrade, meaning it can trade in and out of things. unnecessarily, which increases your trading costs. So if you put a threshold, it just means that it's going to trade only when it needs to. And you can play with whatever the threshold amount and see how it changes things. So what I'm going to do is, now that we have this, I'm going to run this over 3 years and see what we get. Okay, we're going to go back up here. So we have a 40% annual return with a maximum drawdown of less than 10%. Let's see how that compares to the NASDAQ itself. I'm going to add that in here. We have this symphony or strategy that we're looking at in green. We have the S&P 500 represented by SPY, and then we're going to add a benchmark, which you can do here to compare. I'm going to add that QQQ. So we could, if we had just bought QQQ by itself without putting any conditions in, this is what it would look like. All right, so here it is. You can see the QQQ and SPY are pretty close together down here. Outperformed, QQQ did outperform the S&P 500. But let's take a look at the actual data here, okay? So when we look at it over 3 years, we have an annualized return, which means the average return over 3 years. So average return for the S&P 500 is close to 14%. For the NASDAQ 100, close to 17%. But the drawdowns are significant here. So you're getting 17%, but you have to live through almost a 30% drawdown, or a loss, quote unquote, in your portfolio until that recovers to give you this gain. Okay. Same with the S&P 500. You have a 22% drawdown versus a close to 14% gain. So look at the symphony though. With doing what we've done up here, and I'll run through this again. You'll see that you get more than double the return of the QQQ or NASDAQ 100, and well, more than triple. Is that right? Yeah, about triple what you get in the S&P 500. So, and the drawdown is very reasonable at under 10%. So it's pretty much 4 to 1, the return versus the drawdown. I like to look at that as a ratio. It tells me the level of safety that I have in that trade. All right. Also, standard deviation, just to go through a couple of these other terms here. Standard deviation indicates the amount of volatility within that that holding. Okay, so you could see that the S&P 500 has a 17% standard deviation, which is kind of standard for that. The NASDAQ 100 is higher, meaning a little more up and down, more volatility, right? And then you could see that the standard deviation for this symphony is 14. It's less than both of these. We have a low drawdown. And then the Sharpe ratio is a measure of how efficient the return is for this. So a higher number is better. You can see that both of these are under 1 at 0.8. So this is 3 times it's the performance in terms of Sharpe ratio. There's another thing here called Kalmar ratio. So this is basically looking at the drawdown, which is this number here. The higher the Kalmar ratio means the better you sleep at night. That's essentially the way to read it. Okay, it's a kind of a safety number and it's looking at how much does the stock go down while it's trying to, get through this 3-year period. Okay. All right. So now we've done that. Let's take one more look at this. We're going to go through this. I'll do one other thing just as a general run through of some of the parameters that you can look at. There's a couple of other things that you can do. I'm going to just save this. I'm going to make sure you save your changes. What I'm going to do here is show another way, something else that you could do, which is a filter. Okay, a filter says, if this is true, then do this. It's kind of like a condition, but it really just says how to sort things. Okay, so let's take a look at this. I'm going to say cumulative return over 10 days, mean how much has it gained over 10 days, and we're going to choose the top two, and I'll just put in some, you have 10-day cumulative return, top two, and we're going to go ahead and add some assets here. So let's say GLD, okay, GLD, the US dollar. Let's try a TLT, which is a bond fund, and let's put BTAL. All right. So what I've done here is I have 4 choices, but I'm going to choose the top 2. This is going to look for this 10-day cumulative return. If that changes, one of these is we're only going to have the top 2 performers. So let's see what happens here on this. Okay, so we have a slightly lower performance than we had before I did this, but that's the nature of experimentation. You know, we had a 40% return. This isn't bad, but it's not as good as the other one. But I just wanted to show you that you can use a sorting mechanism to actually have multiple ETFs or symbols. Could be regular stocks. I'm using ETFs here, but you could just as easily use Apple, Nvidia, Microsoft, whatever you'd like to do. In fact, let's just, for kicks, we're going to add Nvidia in here. I'll bet you our returns will go up considering its performance. All right, Nvidia, and now let's see what happens to our return. Okay, we gained a couple of points there, but we also have a larger drawdown. So you always have to look at, you know, the symbols that you're adding. They can add volatility to your symphony or strategy. Okay, so I'm going to take this out, and I'm going to add back in what I had in there, GLD, and then the dollar. And we're just going to make sure that goes back to the way we had it. Oh, 33. I might have changed something here. Well, the other thing you can do is you can undo. I'm just going to do that and see what happens here. Okay, there's that. When you undo, it takes each event. I can't really show you while I'm doing it, but it's going to, one at a time, it's going to take those individual symbols that I typed in out. See, we're almost there. Undo, undo, undo. Let's see if we're back. Okay, not quite. I'm having to scroll just because I have the everything magnified here a bit. Okay, so let's add gold in here. GLD, like that. What do we got? And we were doing this over 3 years. Okay, I think that's going to do it. 37. Oh, got to add the gold in there. This platform is very specific. In other words, you don't usually get different outcomes, which is a good sign. There's the 40% we had. So I'm back to where we were. I'm going to save this. And I'm going to do one more thing just to show you another thing that you can use with this. The other thing you can do here is you can, if you want to, let's just say that I wanted to put the SPY as equally weighted here. We have the QQQ and the SPY. This is the equal weight. However, if you want to, you can do this and select specified. And if we do that, it's going to ask for a weighting. Oh, I didn't want to do it that way. Hold on a sec. Take that out. Oh! Now, if you delete something, just go ahead and do undo, undo, and then you're back to where you started. Here's what I'd like to do. I'll take those out, and I can add a weight here. This time I'm going to say specified. All right, and I'm going to say I want to be 75%. in the QQQ, and I want to also add another weight, 25%. See this red exclamation point? If you don't have it adding up to 100%, you're going to get one of these. So make sure you got your percentages right. See, that went away. So now we're going to put a SPY in here. All right. And we're going to just look at it. This is probably going to go down. We'll see. Yeah, it goes down by a couple of percentage points, just because I'm playing around with different weightings on different stocks or ETFs. So since I don't want to do that, I'm going to take that out, and I'm just going to put QQQ in here again. And there we go. Save. We're going to run that. There's our 40%. I'm going to save it. And I don't know if there's anything else I'd like to show you today. Let's see here. I can just show you a couple of other choices that you have on this conditions menu. The most often used ones are either a price as it relates to a moving average of price, either exponential or moving average. You have the relative strength index, which I used here. You also have moving average of return and standard deviation of price and return. These are, in my experience, use them less. So the main ones that I use are cumulative return and where is the price in relationship to a moving average. So you could see on this one, the QQQ, today's price is greater than the 200-day moving average. So that's one of those examples. So although you have these different options to choose from, I don't generally use the other ones, but you're certainly welcome to experiment, because sometimes it can be relevant. But in my experience, you generally deal with moving averages, cumulative return, or relative strength. Okay, so that's pretty much it. Make sure you always save these, and when you're done, I use the little triangle here, close it up, save it that way, because you can then do things. You've got this symphony that you've created. It's giving you a 40% return. And just for kicks, I'll show you the last thing that we do here is I'm just going to grab, say, another one that I had created. Let's do this one. I'm just grabbing it from another screen here. So each symphony I create, I said I created a group, which is a label, and you have the ability to mix strategies or to equal weight them. So I'm just going to do that. Throw that in here. I'll add another plus here. So I've got an entire strategy here. I'm going to add another strategy. Just in this case, you copy it. If you're copying from another strategy, just go over here and say copy. But I've copied it from somewhere else, so you'll see this is different. All right, so I won't explain what this is, but just for kicks, this would say that you're going to have a 50% weighting, whatever you invest. If you put $2,000 in, it'll be $1,000 each, for this strategy. And I'll just run it and see what happens. So you can see these, when they're running together, they do very well together. So I've had a huge improvement, almost double. And guess what? The drawdown has gone down significantly as well. So this is actually a pretty good one. Now the problem with this is that this you get a message like this. It usually means that they don't have enough data for the 3 years that I've been using here. So I'll just do 1 year. Click 1 year, and you see, there we go. We have it there. How much is that? So it's still hanging in there at a very reasonable annual return. So I'm gonna take a look at that because they go well together. Anyway, so that is the demo for today. Since I don't want to keep this as it is, I'm going to go ahead and I can just go. I usually hit the back button on the browser, and what that'll do is it'll give you a message saying, do you want to save what you've done or you want to discard it?